Good evening, ladies and gentlemen. Good afternoon to some of our guests from Paris, and good morning to Jim at Chicago. On behalf of the CFA Society in the MENA region, I'm delighted to welcome you to the Forecasting Dinner 2021. While the current pandemic has put a brake on our live events, the board of CFA Society Emirates continues to work hard to bring you quality events. It's only 27 January, and this is already CFA Emirates' third event in 2021. On 15th and 16th of Jan, we offered
Okay,
members a complimentary two-day course
okay,
on
you controlling
introduction
her?
to Python for finance professionals from an excellent instructor based out of New York. On 23rd Jan, the career chair Binod hosted a talk with a partner of Ernst& Young about careers in consulting. We will shortly be hosting some C-level executives of the largest real estate companies in the region to talk about key trends in GCC real estate. So please do look out for our monthly events. I'd like to welcome our speakers, Laurent Denise and Jim McDonald, and I'd like to welcome back Jean Chia and MR Raghu, who've been past speakers and friends of the CFA Emirates Society. Now, in the words of the famous French writer Voltaire, the present is pregnant with the future. So I'll leave it up to our speakers to read the present and give us their insights on the future. However, I'd like to take this opportunity just to paint the picture of the present and the journey to here. 2020 was a catastrophic year for lives and livelihoods with coronavirus. Jean Chia rightly identified this as a global tail risk in our last year's forecasting dinner, at the time when the virus was still centered in Wuhan. By some estimates, the number of people living on less than $5 per day increased by 400 million in 2020. I couldn't find the Gini coefficient numbers for 2020, but I'm fairly confident that they are closest to one than they have ever been in history. However, the global financial markets is a completely different story, and the dichotomy between Main Street and Wall Street has never been wider. Speaking of equities, 2020 has been a wild year. From the 30% fall we saw in March to the full recovery by June and the continued bull run with S&P up 15% and Nasdaq up 40% for the year. In 2013, Jeremy Steins, who was then a member of the Fed, had critiqued the easy money policy, saying that the increased turnover is not the only channel money creation can find, and that other channels include asset bubbles and financial engineering. The gains that we've seen have been predominantly captured by the tech sector. At no time in history have we seen the top 5 companies by market cap on S&P 500 being from the same sector, all tech companies and accounting for over 30% of the market cap of S&P 500. Does this reflect the market opinion of future gains will be captured by the tech sector? Or is this the transition from service age to the knowledge age? Or is this just bubble territory? In March 2020, I had attended the Fund Selector Middle East conference where Odo had called the tech sector. And what an incredible run it has been for the tech stocks. So congratulations to Laura and his team at Odo. 2020 also saw huge participation from retail investors, the much talked about Robinhood effect of people locked up at homes and having access to zero brokerage accounts. We also saw Bitcoin going gangbusters, and we saw the love for gold, which was up 20% for the year. Is this portfolio insurance against printing money, or is it the effect of too much money sloshing around? Speaking of fixed income, in December 2020, Bloomberg reported that the value of debt trading on negative yield topped $18 trillion. This seems like broad daylight heist from the pensioners and savers. I'm reminded of the recent Netflix series, The Scam, on the Indian stock market operator called Harshad Mehta. Private citizens end up in jail for playing with money that they don't own, but the developed market governments seem to do this with impunity. Speaking of geopolitics, the gyrations were no less in 2020. The year started with the protests in Hong Kong and ended with the protests in and around the White House. And Jack Ma was conspicuous by his absence. United States has a new president with a significantly different policy agenda. So this is where we are. And I call upon our first speaker, Jean Chia to enlighten us with a forecast and thesis for 2020-21. As an introduction, Jean is the Chief Investment Officer and Head of Portfolio Management and Research Office at Bank of Singapore. As the head of PMRO, Jean is responsible for CIO views, discretionary portfolio management, advisory portfolio management, and funds due diligence teams at Bank of Singapore. She has over 20 years of experience in private banking and asset management. She was previously head of client advisory services for equities, investment products, and services at UBS Wealth Management Singapore. Jean is a graduate with an MA in philosophy, politics, and economics from the University of Oxford. Given Jean's past track record, I would personally be paying a lot of attention to the risks she identifies for 2021. So over to you, Jean.
Thank you, Tarun. You're a very gracious host. And as usual, thank you, CFA Society, for having me all the way here from the East, as Tarun puts it. So tonight, I really hope that apart from highlighting the risks, I will be able to also point you to some opportunities. I hope not to be so accurate on risks and hopefully more accurate on opportunities this time around. But it's one of those things that you wish you did not get it right? I think, as I recall, it was after the panel discussion and the question was asked of the panel to identify a tail risk each. And at that time, the COVID-19 virus had not been christened as COVID-19 just yet, and it was just had a vague name like Wuhan virus, and the news flow, of course, was starting to hit the tape. And what a year it's been. I think all of us personally have certainly experienced to some extent the grief as well as the pain that it has hit our economies the world over, and we could wish for nothing but that the virus goes away. So I think the first thing I would like to speak about, let's get the negative out of the way, is really how this vaccine development is really holding the key to our optimism about the global markets, especially the global economies. Now, I think what we've seen, of course, the best news that we heard in the final quarter of last year, and certainly even yesterday, is that vaccine developments have unprecedented progress. And I personally interviewed my own alma mater, Oxford, and I'm extremely proud to say that the vaccine developments are really at record-breaking speed in terms of testing. And certainly, we have seen good news from Pfizer, Moderna, AstraZeneca, and hopefully soon Johnson & Johnson as well. So the key here at our Bank of Singapore event, actually a week ago as well, we asked our clients in a poll, a survey, when they think countries will reopen. About half of them basically said they thought this would be the economies will fully reopen this year, and another half said it will be next year. Now, I think here's the nature of the beast right now, is that each of us residing in all the countries that we are from today, we are experiencing a very divergent pace of recovery, precisely because of the situation, whether it's with the vaccine or even the virus mutations, and the extent to which this has been put under control by our respective governments, and certainly behavioral as well. So I think what this points to is that the pace of recovery globally is going to be very uneven. And it's also very dependent on the pace of inoculation. I mean, who would have thought that today, as an economist or as a strategist, you have to also be a virologist? But certainly, we see very encouraging pace, actually from your region, whether it's the UAE or Israel. The number of inoculations per capita is actually the fastest globally. And we take inspiration from that, certainly here in Singapore as well, where the government has declared that they have sufficient doses, vaccine doses, for the entire population as well as residents. Now, that's not something that many countries can claim to at this point in time. And so we do expect that this is really the key differentiator going forward in terms of economic recovery. At Bank of Singapore, you can see our numbers here in terms of global growth forecast. Our forecast is 5.7% worldwide, and a sharp rebound from what we saw last year, which is -4%. IMF, of course, yesterday came up with their forecast of global growth in 2021 of 5.5% and 4.2% next year. And we certainly hope that we'll be roughly in the ballpark here. We upgraded our US forecast from 5 to 6% for 2021, primarily due to the really great sort of news this year, of course, of the fiscal boost that has been brought about with President Joe Biden's fiscal policy. So I think these are really the positive aspects that we can hope to achieve. Now, the analogy I like to sort of share at this point is, if some of you may know, in the Japanese art called Kinzugi. Kinzugi is basically an art form where broken pieces of ceramic are mended together with lacquer and gold, and the product is more beautiful than the original broken piece of art, and certainly oftentimes it's even stronger. I think Tarun points to the fact about the Gini coefficient. I think what COVID-19 and the circumstances of last year have taught us is that the fault lines within the economy, such as inequality, such as structural weaknesses in businesses or industries, those have come to the fore. And it's really going to be incumbent upon the central banks, governments, as well as companies and industries to repair these fault lines, if you like, in the economy and hopefully emerge stronger. And it is with no surprise that Joe Biden's mandate is to build back better, build back stronger. So we think this global growth rebound is very conducive for us as a backdrop, and the economics of 2021 will be about recovery and hopefully a reset in the economy as well. We move on to our next slide. I mean, the flip side of the coin clearly is inflation. And that's the tail risk that a lot of market watchers are now looking very closely at. Now, if we get back to growth and inflation does pick up, would there be the specter of a rate hike in the horizon? I think the Fed has taken great pains to reiterate that this is not the case, at least in terms from a policy perspective, in terms of what they intend to do, which is inflation targeting. Now, as we expect that inflation should pick up in a positive manner, and that's not out of the blue question because there will be easy comps from last year. We expect sharp recovery and certainly a cyclical growth recovery. What we see is potentially there's still slack in the labor market, technology innovation that has certainly kept capacity utilization relatively controlled, even if we roar back into growth. And commodity prices, while they're on the uptrend, I think the whole climate change agenda could put a lid onto the expectations of commodity price increases. Now, if inflation even hits 2%, say this year, I think what the Fed is guiding towards is that we would have to maintain 2% inflation rates for as long as a full year before the Fed would hike rates. And certainly the other fear, which is tapering, that's also been pushed back, I think, from the Fed narrative at least. So global growth will have several legs of support. Firstly, the near zero interest rates, quantitative easing, and the huge fiscal deficit that continue to fuel the respective economies. On the next slide, I think we have seen that bond yields certainly have risen, but we think that this is potentially something that will remain under control. Our target is actually 1.5% on the 10-year in 12 months. The question, of course, is whether these growth expectations will derail the recovery, and our view is that this certainly is not a disruptive factor in the current environment. In the next slide, that also points to our dollar forecast, which remains that it will continue to be on the downtrend. And as a result, our forecast for the euro is at 130, and the Chinese yuan is something that we have been revising actually on the from 630 to 615 quite recently. Now, the backdrop for our view is, of course, is consistent with this half-full scenario that US economic recovery remains on track. But should we see any derailment from the COVID-19 vaccine or some of these developments hit a snag, the dollar could strengthen as a beneficiary of a risk-off safe haven trade. Now, in our asset allocation, if you can move on to the next slide, we are overweight on equities. And our view is that we are in the early innings of a bull market and the post-recession bull market. Now that seems like a bit of a non-starter given that we've already seen a bull market, but we do think that this is really a multi-year phenomenon, given that this has been a shock from the year before, and the broadening of the recovery will also give impetus and a tailwind to the overall market, overall equity market. In terms of preference, our preference is for US and Asia ex-Japan. Asia ex-Japan being the beneficiary, of course, of an early growth led by China and an early recovery. Now, history does tell us that from the conditions when inflation is low and rising, we've had positive market recovery. There's also, in terms of investor positioning, a fair amount of dry powder and cash, even relative to previous crises such as the GFC and the tech crisis. We have seen that the cash levels remain relatively high. And so from an asset allocation perspective, we think that globally, we could see continued allocation into equities. Naturally, of course, in terms of valuations being the next slide, I think what we've seen even year to date is that earnings recovery continues to be on track. There have been very positive earnings surprise, even from the tech sector, as we all famously saw last week, which of course drove the entire tech sector in terms of share prices to even higher levels at this point in time. So I think earnings-led recovery is certainly going to be also the name of the game across Asia as well as the US this year. Now, so just to summarize at this stage, we think the equity markets will be supported firstly by economic recovery, corporate earnings, and valuations being still relatively supportive. Now, in the next slide, I think the other very key element is, of course, the fact that the hunt for yield across asset classes will remain. As Tarun did point out, the financial oppression, if you like, of the Fed and central banks around the world printing money is that rates remain extremely low. So it's very natural that assets will try to find a home, and that equities becomes a very natural home. We saw last year, of course, I wrote a piece in the first half of last year entitled "The Unbearable Lightness of Dividends." I hope to see dividends recover this year, and certainly we think that strong companies that are able to revert to dividend payments or dividend increases and share buybacks will also drive the recovery, given the lack of alternatives in terms of yield instruments. Now, why Asia? I think this is one of our first key themes for the year, is to focus on Asia and China in particular. It is indeed driven, next slide please, on China's healthy recovery. And of course, 20th of January or last week was a very significant day, not just for the US, but also for Asia. I think the hawkish stance and rather crippling policies that China and Asia have experienced over the past 4 years, hopefully will take a breather. I couldn't say that Biden is entirely going to be supportive of the anti-China rhetoric. I think it will just take a different nature and perhaps a more balanced nature, given that also in the Treasury Secretary, Janet Yellen, as well as Commerce Secretary, Gina Ronaldo, are all moderates as far as policy goes. So we certainly hope to see a more balanced discussion between the US and China, whether it's on trade, on climate change, and other issues that have been affecting the Asian markets. Now, the latest trajectory for China does point towards recovery, but more importantly, what has China done in the last 12 months? I think it's important to note that the very hawkish stance that Trump had towards China actually catalyzed a series of actions from China's perspective, which is to also get its act together. So the 14th Five-Year Plan does articulate a dual circulation policy and hasten China's pace of innovation, focus on technology, and also climate change. Now, what was very surprising, of course, is certainly what Xi Jinping did announce was a surprise to the markets in terms of its aggressive targets towards infrastructure, as well as climate change and environmental industries. The other very important thing is capital market liberalization, the ability for foreign companies to set up shop. Very famously, some of the big fund managers have already begun operations in China. These are all elements attracting capital to China, pointing towards also a stronger Chinese yuan. On the next slide, please. We do have an overweight stance on, in terms of a sector, on financials, materials, energy, real estate, and consumer staples, where relatively benign environment should be positive for these sectors. Moving to fixed income very briefly, I'm aware of the pressure on time. I think Tarun did already mention the zero fixed theme, which is our second theme really. The next slide is that the lower interest rate environment and indeed the large segment of negative yielding assets in fixed income is going to point investors not just towards emerging market high yield, now on the next slide again, but certainly because there hasn't been alternatives. Sorry, if you can move on to the next one. Right, so Tina, and you all know this, the lady in town now, which is there is no alternative. The negative yielding assets certainly do push us up the risk ladder to emerging market high yield from an asset allocation perspective within the Bank of Singapore's preferences. But also we think that there will be a move towards alternative assets such as hedge funds, private equity, and private debt in this new environment as well. Finally, I want to save my last 5 minutes really for a topic that's close to my heart, which is climate change. I could move on to the next couple of slides. Now, I think, yeah, so within China, just to point out, within emerging market high yield, sorry, China remains our preference. And the reason really is that in most fixed income indices today in the emerging market space, China is now a hard to ignore segment of the index. And certainly in terms of the quality of corporates as well, we do see high quality issuances and more recently, even green bond issuances from China, really pointing towards a very new environment. There is a term in fixed income that has come up called greenium. And we do note from the recent issues that if you have an ESG element, even in your structure, there will also be pricing advantage for the issuer. I think that, unfortunately, altruism and goodwill aside, will also draw a lot of issuers towards the green bond, social bonds, or even sustainable bond area. And that's a whole new topic all by itself as well. Finally, I would like to spend my last couple of minutes, as I mentioned, on climate change. If you could turn to my last 2 slides, please. So I think the key here is that the extreme weather conditions and the impact on biodiversity, we all know, will actually set us all on a path, which is the 2.7 degrees Celsius increase in temperatures by 2100. It is incumbent on us as investors, and especially you being the CFA society, to really guide this trajectory. I think enough has been said by the NGOs, the non-government organizations, in terms of lobbying. But really, I think it's time for the industry to put money where our mouth is. And that really is of great urgency and importance in terms of how investors behave. Now, what we've seen in the pension funds globally, and of course, Europe being a forerunner of this trajectory, is something we of course look forward to. Here in Asia, I have to say that regulators, whether it's in Singapore or Hong Kong or China, are already waking up to this new reality. So sustainability as an agenda is definitely front and center for all. I think in the US, of course, we are encouraged also that Joe Biden's first job of the day was to actually rejoin the Paris Agreement and articulate, his agenda, which is a federal spending package, and also vouch to reverse some of the damage that was done during the Trump administration in terms of diluting the environmental standards. Janet Yellen, for one, is a big supporter of the carbon tax. And she's a key member of the Climate Leadership Council. If you haven't already read it, I encourage you to search for this Climate Leadership Council recommendations, which is really full of the luminaries of economics and thought leaders in the US supporting the same thing, which is a carbon tax. So we can definitely expect this to come in the coming months, if at all. And of course, EU being the forerunner with the EU Green Deal. And even in the 14 5-year plan, there's a great section just talking about environmental protection as a key agenda, and dual circulation being focused also on energy security for China. So really across the board, I think we do see that the three key themes, as I highlighted, whether it's Asia ex-Japan, focusing on China in both equities, fixed income, as well as currencies. In our ESG agenda, we think that that's front and center in terms of where we should allocate capital, and also in terms of the fixed income space, to look at the emerging market high yield space, but with a focus perhaps on the high quality names, including Asia and China. So that summarizes my thoughts on 2021. I'm happy to take questions when we finish the discussion as well, and look forward to my fellow panelists. Thank you.
Thank you, Jean. Thank you, Jean. Very insightful. Let me move on to our next speaker, M.R. Raghu, Managing Director, Marmon MENA Intelligence. To most, I think Raghu needs no introduction in the MENA region, and even less so to CFA members due to all the good work that Raghu has done for the CFA societies in the MENA region. But as a formal introduction, Raghu is the Managing Director of Marmur MENA Intelligence, a research subsidiary of Kuwait Financial Center, a leading asset manager based in Kuwait. In a career spanning over 33 years, Raghu has spent 22 years in the Gulf region. Prior to this, Raghu worked with several leading institutions based in India, including the Unit Trust of India. Raghu is a CFA charter holder, a certified financial risk manager, and a cost accountant. Over to you, Raghu. Raghu?
Hi, Tarun.
Hi, we can hear you. Hello?
Very good. Okay. Thank you, Tarun. I think I had some audio issues, so I missed your introduction, but hopefully you must have had some good words for me, since you're a great
Right.
friend, and I have a lot of friends in CF Emirates. Thank you very much. I will yeah, get 2008 and in 2009, I remember telling a colleague that this is probably the biggest of the crisis I would have ever seen in my lifetime. In 10 years, I think I was proved completely. And here, uh, so, so the character now should risk management,
Raghu, sorry to interrupt you. I think
management.
a lot
So
of
with that
people are,
brief introduction, if I can,
I think we are having some audio issues with Raghu. Uh, so in the interest of time, shall we, Laurent, can we move on to you, and we will come back to Raghu after the after he's able to reconnect?
Yes, Darren, of course.
Okay, that's great. Thanks so much.
You're welcome. So maybe you can move to my presentation.
Yeah, and while I just do a brief introduction,
Yeah.
so Laurent Denis is the global co-CIO of Odo BFHAM, which is a leading independent asset manager in Europe. Prior to this, Laurent was a senior bond manager, head of investment solutions at Odo Asset Management, and the founder and deputy CEO of Anakina Finance and chairman of DDF Exclusive. He has also held roles with Caisse de Dépôt in equity-linked products, proprietary trading, and Credit Lyonnais in interest rate brokerage, credit, and trading. Laurent holds an actuarial degree in and is a graduate of ESC Toulouse. He also holds a master's degree in banking and finance from Lyon 2. Over to you, Lauren, and apologies for all the pronunciations I may have butchered in your introduction.
No, don't worry. All right. First, let me tell you that I'm really honored, all right, to participate to the CFA Society Emirates dinner. So really glad to be here with you. So maybe if we can move to the presentation. It would be in three parts. First, a global picture, and then after our macroeconomic perspectives, and then our main convictions. I would try to give you our best convictions in this very difficult environment. Next slide, please. Next one. So 2020, and I would go very quick on it, has been an extraordinary year. We spoke about it. You spoke about it, Taron, in the collapse and the pace of the recovery, linked, of course, to the support of the central banks, but of course, linked to the fiscal stimulus from the different regions and the government of the different regions, but also, and I think this is very important to highlight, about the characteristics of this shock, which has been an exogenous shock, and I would elaborate a bit more about it. Next slide. 2020, extraordinary also in terms of performances of the asset classes. You all know that, all right? So I won't comment too much, but nevertheless, let me say one very important fact. A 50% performance on assets when we live in a zero rate environment is not something normal. So do not expect, all right, to have that kind of returns next year. It has been linked, and Jean has said that, to the excess money, the excess liquidity that has been driven the performance, and especially the premium expansions and the multiple expansions. But do not expect to see, for example, Bitcoin taking more than 300% next year. Next slide. So if we focus to our market, so let me give you some more hints about the European market. It seems that the investors have been fairly cautious, and let's put things into perspective. On a 3-year horizon, they haven't positioned themselves on the European market. Fairly optimistic beginning of 2018, but then after hit by the market turmoil, and only recently have we seen yes, large equity inflows linked to the vaccine efficiency. And next slide. It seems that investors' mindset is fairly optimistic this year, and a bit too optimistic maybe, because it's a consensus. What kind of assets do they favor? Developed market equities and emerging market equities. This is coming from Goldman Sachs Market Quick Pool, and they want to get rid of government bonds, and they are bearish on US dollar. Do we share those views? This is the aim of this presentation. Next slide. But let's face it, we are entering the decade in a very, very special environment. More inequality, more debt, more digitalization. We need to reinvent ourselves in terms of asset allocation. And I would try to give you 3 angles, 3 themes of investment. Next slide. Let's go through first our macroeconomic perspective. It has already been said by Jean, but nevertheless, I will try to give you our main convictions. Next slide, please. Of course, we all know that the virus is the key input of the macro scenario. It's a fairly optimistic one, But something very important that has to be mentioned is the fact that the correlation between the mobility and the activity is decreasing, which is fairly good news, meaning that even if there is a lockdown, it may be the case in France, in Europe, all right, for the coming weeks, it's having a less impact on activity. And eventually, it means that the recovery, even if, let's say, it's postponed, there would be a kind of postponement moment, but then a recovery. The trajectory is not, of course, is going to be a hectic one, but at least we believe that the macro scenario is going to improve sharply up. Next slide. I said it at the beginning. This is an exogenous shock. This was even driven. This was a decision that was taken by government. It's not a process-driven shock as we've seen usually, meaning that the manufacturing capital or even the human capital through the support that has been done by different government is really making it different. There are no imbalances in the policy tightening. There are no imbalances coming from endogenous issues. And this is why we do believe that the return to pre-pandemic level is going really to be much quicker than in a typical recession. Next slide. Financial conditions, and this is also very important to mention, they are back to normal. And we do not believe that there won't be any change from the monetary policy, either in the US or in Europe. Next slide. Speaking about business conditions, it's fair to say that PMIs have recovered much more in the US than in Europe. Of course, linked to the lockdown, all right, that was much higher in Europe, but the recovery that we believe is going to go through is certainly going to accelerate in Europe more than in the US. And these hopes of mass vaccinations are going to accelerate this recovery, especially in the service sector, where there is really much more room for improvement. Next slide. The key factor is about consumption. And we all know that there's been forced savings everywhere. In the US, the saving rate has jumped to 15%. Now it has, let's say, consumption has accelerated, but nevertheless, it's between 5 and 10% over historical standards, meaning that there is a pent-up demand that is likely to revive consumption and revive it to pre-pandemic levels and, let's say, favor pandemic hit industries. This is one of the main factor of recovery. Of course, we will need to see whether it may be postponed through, let's say, unemployment figures or, let's say, a postponing of the recovery. But nevertheless, again, we believe that this is one of the main factors of an increase of the recovery. Next slide. Do not expect growth to close the output gap in 2021, of course not. But we hope for a 6% GDP global growth for this year, which is above the consensus through the mass vaccination that even if it's delayed, is going to release this pent-up demand in many service sectors. Of course, there are risks on that scenario, and of course, vaccine, but again, this exogenous shock has not destroyed the capacity of recovery, and the excess money and the fiscal stimulus that are at stake are going to sharply increase growth over the potential. Next slide. Inflation, Gina has spoken about it. We do share the view that inflation is going to accelerate, linked to this robust recovery, linked to this very accommodative stance. Remind you that the excess money is 7 times higher than than just after the global financial crisis. And then there are basic effects, all right? Commodities moving sharply up. That allows to anticipate a strong rebound in headline inflation figures. But at the same time, deflationary pressures are still very important. Unemployment, the lack of productivity increase are still factors that are not going to allow a sharp upside move of inflation. Nevertheless, inflation would have to be taken into account, and this would also be very important of the capital allocation, the asset allocation. Next slide. Very quickly, US economic policy, monetary policy. You all know that the Fed has changed its mind in terms of strategy. This is a flexible average inflation target, but it doesn't mean that they would change their policy anytime soon, even if inflation is picking up to more than 2%. And I remind you what Janet Yellen was saying when she was head of the Fed. I'm ready to see the inflation in the blink of the eyes. And I think Jay Powell shares the same point of view. In terms of fiscal policy, it has been said $1.9 trillion, maybe not fully implemented, but nevertheless added to the $900 billion, let's say 1.1 trillion, this is our assumption. It's about $2 trillion, which is about 10% of the US GDP that is going to be spent, which is massive. Next slide. About the same picture for the Eurozone with a different scenario for, let's say, strategy for the ECB. This is not a yield control, this is a spread control strategy. And I think Mrs. Lagarde really shares Mr. Draghi's point of view about fighting against the fragmentation of credit. And I think what the ECB is going to monitor is the difference between the German 10-year and the Italian 10-year spread. And this is very important. And I can tell you that they won't let it widen too much, because this is the key factor of the cohesion of the European space. In terms of fiscal policy, you all know that the 750 billion plan has been ratified, which is really good news. And let's say for the first time since a couple of years, some coherence in the fiscal policy among the countries, and the willingness to issue together some European bonds. This is a massive step, and I can tell you from Europe, this is a very important factor for the investment in the European space. Next time. It's not, let's say, a pink picture, of course. We all know that there are major differences among the countries in Europe, especially between Germany and France, the two engines of Europe. And you have some slides here about the unemployment rate or the consumer confidence, without speaking about the debt to GDP ratios. And it's about the question of what would go on after the COVID crisis. But I think it would be a mistake to believe that this cohesion is not going to hold on. I think the mindset of our governance has changed. They believe that the only way to reimburse debt would be through an increase of growth over the potential and then investing. And this is why it allows us, all right, to be more optimistic on Europe than in the past. Next slide. What about our convictions? So I've said it, we're more, next slide, more optimistic about growth. So we need to favor equities. Chin has said it, I share the same point of view over fixed income. Why? Because risk premium are still offering a decent premium. It's taking all metrics, dividend yield minus sovereign rate, or return on shares versus sovereign rates. It's about 3 to 4% in the US and 4 to 6% in Europe. And this is far above, all right, the zero, and this is still attractive. Next slide. But what kind of equities? Three angles. The first one, next slide, is about structural trends, all right? And let's say it, all right? the crisis has not created those trends. The crisis, the COVID-19 has just been an accelerator of the positioning of the investors towards technology, towards ecology, towards healthcare, and without speaking about this ESG, which is the massive trend that has just started. Next slide. The only way to capture it, all right, and I've quoted here some trends that we believe are really going to create value. Next slide, is to position on global thematic funds, global thematic equities. You've seen during the year of 2020, the outperformance of the different sectors. Retailing it's of course e-commerce, semis or media, without speaking about Netflix. You've seen value creation. It's a long-term performance that you need to capture, you need to be positioned on. Next slide. That's true, but I think that we are living in a key moment. And the very good news is that I do believe that all regions are really committed to fulfill the COP21 engagements. And it's not only about Europe with the European Grill, it's also about China. You've seen 52 billion of euros invested to target to reach this carbon neutrality. It's about the elections of Joe Biden that allows the United States to be back, all right? And then we are speaking, and let me give you some figures, about 1.5 trillion to 2 trillion investment per year. I repeat, per year, meaning massive opportunities for investors to participate in this global trend. And I think this is the main trend that you need to position. And we've seen last year the performance of the climate change indexes versus the usual indexes. And this is just, again, the beginning. Next slide. Doesn't mean that you cannot think about, let's say, some kind of tactical trades, meaning that we are close to see the end of the tunnel, all right? We are seeing the light, all right? The COVID-19 through the vaccines may be let's say, something that we would have forgotten in a couple of years. So how can we position ourselves to capture the normalization of the market? And why now? Why now? Because of course the vaccines have been a game changer, but also confidence is back, especially in Europe with the ratification of the recovery plan, but also with some kind of political risks fading, either in the US or in Europe. And this is also very important for this mean reversion that should occur. And it's not only about growth versus value, but it's also taking into account geography, taking into account sectors, and also style. Next slide. And I think the ingredients of the rotation are there. Why? Because we've seen break-evens sharply up, especially in the US, above 2%. It doesn't mean that, let's say, the monetary policy, as I said, is going to change anytime soon. No, money market rates are going to be anchored, but the long-term part of the curve is going to go higher, meaning some more steep curves. And this is the key ingredient of the rotation. And we are starting to see, with the inflation figures picking up, this normalization of the yield curve. Next slide. So what do you need to do? You need to favor companies that are going to provide the biggest momentum in terms of EPS growth. Again, it's not about PE expansion, that's where you are going to create any value. And then it's about emerging markets and Euro stocks, our two main regions. Next slide. What sectors? Very cyclical sectors: oil and gas, automotive, construction, banks, because of the valuations that are so attractive, and because of the steepening of the curve, we are a believer that there should be a sharp rebound and significant performance that can be driven by banks, and also linked to the consolidation that is taking place in the European space. Next slide. Geography, European stocks. Why? Because of course of the earning catch up. It's about 10% difference, 42% EPS growth, our assumption in Europe versus 30 in the US. More attractive valuation, you all know about that. And also a tilt to cyclical names that is also very interesting after the tech rally that we've seen in the US. I would include UK. Yes, we know about the Brexit. But I think UK is also offering a very interesting risk return profile. So I would include UK in the European space. Next slide. I won't elaborate too much about emerging equities because I do believe that one of my colleagues is going to speak about it. So next slide. I believe that this is a very good tactical trade, but next slide, please. But I would highlight risks, and I would say it's only tactical. Why? Because I think the leeway for central banks is limited, and then the debt to the GDP ratio are really elevated. So some cautiousness about the emerging market on that side. Next slide. Then it's about my favorite topic, small caps. Why? Because traditionally they've been the main beneficiaries of the relaunch policies, but also, next slide, because of, let's say, the theoretical risk premium that is still at stake, all right? More growth, that's for sure. And in this environment, and this is on the bottom left of the slide, yes, valuations are quite stretched, but in a relative basis, they are offering value versus large cap. And this is the next slide. I think the good news is also that they are overweight on cyclical sectors. You can see it on that graph, industrials, consumer cyclicals, and this is also very good news if you believe in this mean reversion, if you believe in this rotation that could occur. Small caps, and they would be held by the plans, the recovery plans. Don't forget there are domestic recovery plans, meaning domestic, it's about Europe, it's about the US or let's say Asia. And I think they would be the main beneficiaries of these relaunch policies. Next slide. It's time to take profit on bond proxies. I would say Nestle as an example, nothing against Nestle, but you all know what it means, all right? So high predictability on cash flows, but not such a growth of EPS. They can be impacted by some higher rates, so let's be cautious on that. But the main question is about, next slide, how, let's say, to analyze stocks like Tesla. Is it irrational or new reality? Irrational, very easy. They produce 500,000 cars, and let's say Toyota is producing close to 11 million cars. The revenues of Tesla are equaling the profit of Toyota. And then what about the market cap, all right? We all know that the sum of the market caps of the automotive manufacturers is less than the market cap of Tesla. Yes, so irrational, but, and it's fair to say that it's recognized by the industry itself. Tesla has a 6-year advance in technology. This is not me saying that, this is Mr. Tavares, the head of PSA. And he said that closing the gap would be much more difficult than what they believe. So there is some kind of legitimacy of having Tesla, let's say, showing that kind of market cap linked to this disruption that has occurred. But how to handle it? And I can't tell you that Tesla is worth 600 billion or 300 billion or 900 billion. I don't know. I don't have a clue. But what I can tell you is that there is a methodology, and this is what we can propose, next slide, to try to capture, all right, that kind of stocks, that kind of company. How? Through artificial intelligence and an arm of artificial intelligence, which is natural language processing. It's an approach to analyze unstructured data and not only the balance sheet. So how does it work? Next slide. it's, let's say, analyzing the language and try to structure the unstructured using words and transform those words in, let's say, numerical data. So you analyze an article and you try to define the words and the sentiment linked to these words that are attached to companies, and then after you score the companies. And next slide. And I remind you one figure. 80% of the data in the world are unstructured data. If you miss that part, you're missing most of the information of the world. And it allows you to disrupt yourself in the way you analyze companies. Because if you think about the fundamentals only, you never buy Tesla, you never buy Moderna, you never buy that kind of stocks, because Tesla is worth 1,300 times their profit, which is on a fundamental basis crazy. Moderna, just as an example, has transformed itself from a biotech to a company that would produce 1 billion vaccines and sell them at $20. So $20 billion revenue for a company that was a biotech. You could have captured this momentum through the NLP. And this is what we are trying to do on our strategy and our thematic strategies. Next slide. You've understood it. So next slide, please. The positioning. Fixed income, I would go very quickly. I think there is more pain and no gain, all right, especially on rates. Be very cautious on the long duration and the long part of the curve. Remind you that the duration of the 30 years bond is 20, meaning that if rates are moving up by 1%, the loss in capital will be 20%. And we might not see 1%. But still, it can be up. And our expectation is on the 10-year US rate 140, meaning that the 30 years can go even higher. All right, so some cautiousness. On credit, next slide. I think it's also not easy to position oneself in the European space or the US one. Why? Because spreads are really tight. Main beneficiaries of the monetary policies and this eviction effect that we've seen. And so the only way to let's say, handle those higher bonds is through carry. Do not expect more than 2 to 3% performance, no capital gain through any spread tightening. Next slide. That's true, but it's also true and fair to say that yes, we would see some bankruptcies for sure, but not next year. All right, the expectation in terms of let's say monetary support or let's say government support is not going to fade anytime soon. Meaning that the expected default rates are even decreasing month after month, and I do believe that the high-end market has taken it into account. Next slide.
Laura, I'm afraid we're just running a little ahead of time.
I'm finished. All right. So
that's
fine. That's fine with me. So that's it for me for the convictions. And I think the most important is those three investment themes. All right, the structural trends, capturing the rotation, and then trying to capture, let's say, the retail investors' momentum. That is also very important, and the only way to do it is use artificial intelligence, let's say this way, or another way is through big data analysis. Thank you.
Thank you so much, Laurent. Coming back to Raghu, I hope our technology issues at Raghu's end have been sorted out. I think in this region, Raghu needs no introduction. He's obviously been, a key member of the CFA societies in the MENA region. He's been a frequent guest of ours at CFA Emirates. Just as a formal introduction, Raghu is the managing director of Marmor Intelligence, a research subsidiary of Kuwait Financial House. And he spent about 33 years, of which 20 years have been in the Gulf region, prior to which he was with the Unit Trust of India. Over to you, Raghu. Raghu, can you hear us? I guess no matter how much you test beforehand, sometimes the technology just seems to fail you at the right moment. Oh, I see Raghu's re-entered. Raghu, can you hear us? Raghu?
Yeah, can you hear me?
Yeah, there's a very strong echo at your end, Raghu.
Yes. Yeah, that's sorted out now.
Yes, thank you.
Yeah. Thanks. Thank you, Tarun. I'm lucky because I got introduced twice. So, thank you very much for that. Let me jump in very quickly into what I have to say. Um, I've been listening to the other presenters, and they are predominantly yeah, pretty much focused on the asset class calls. What I'm going to do is have a slightly a different take in terms of how I see things. Probably I will focus on GCC and then try to raise some contextual issues on things that are facing our markets. So if I can jump into these slides and if someone can please, yeah. As you can see here, it was certainly a party time for global markets and emerging markets. As you can see, the YTD returns, which were quite strong. But that's not the case with GCC. And you can see that many GCC markets were struggling through 2020. That's primarily on the back of a fall in the oil price and also the COVID. So we had a double whammy impact for GCC economies, where the non-oil GDP for GCC came down significantly, and the oil GDP as well. It reflected in terms of the risk perception, as we notice on the CDS spreads, as some markets like Oman experienced a sharp drop in the CDS spreads, especially during the March mayhem, and then it rebounded back. Suffice it to say that this COVID called for a very massive response from the Fed, and you can see that the Treasury yield curve, how much it sloped downwards, especially on the short end of the curve. This is unprecedented changes in the BIPs. I don't think we will ever see these type of numbers, but I already said in my earlier introduction, I said the same thing in 2009 and I was completely wrong. So if you move on, we can see how the markets fell and rose. Now, what is really very interesting to note is the speed of the fall, as you will shortly see from the graph. If someone can navigate to the next one, please. And and also the speed with which things rebounded. Here is on the left side, you will find global markets. On the right side, you will find the GCC markets, and you can see the contrast. So on the left side, we have an unprecedented fall and an unprecedented increase. So much so that most of the markets came above the water, and some of them went on to produce a spectacular performance like S&P 500. But look at GCC. Of course, the fall was as steep as the global markets, but only one managed to raise its head above the water, which is Saudi Arabia at about 3.6, and the rest of them you can see pretty much here. So if we can move to the next one, I can explain as to the global context of what is really happening. Of course, the speakers before me articulated that very well, but it's simply a question of throwing as much money as you can print. And you can see here how the stimulus program, the sheer size of it in terms of the fiscal stimulus and the quantitative easing uh, just makes the whole thing run through. But again, when I talk about the market excesses, I think these excesses are concentrated with the technology stocks because they benefited from very low bond yields. But most importantly, they have earnings far into the future. So if you use the more discount models, you can see that very low rates produce very high valuation, and that's what these companies have done in the markets, the Teslas and the Zooms and the Apples of the world. So these are probably, it's not the earnings that really propel the markets up, but the speed and scale of the response by the banks and governments. That is what has benefited the markets, but not in general. It benefited technology sector the most. We can move on. Uh, Here you can see that I'm not giving any forecast from my side, but I'm curious to see what investment banks have to call. And this makes me slightly uncomfortable because I'm not seeing any negative calls at all across the board. The narrative seems to be the same, very, very positive on equity markets and on the back of extremely low interest rates, period. So, I mean, maybe the range of calls can vary from 1% to 17%, but then it's positive and overweight all through across everybody, and nobody is even providing for a contra view here. So it's going to be a good equity market for 2021 according to these pundits. So let's move. Uh, why such a positive view? Definitely, it's on the back of the vaccine progress that Jean alluded to in her presentation, and obviously a growth rebound. But I would take this rebound with a pinch of salt because these rebounds are happening on the low base effect, and they are by no. If you look at it from that point of view, they are by no means spectacular. But anyway, that is giving a very positive spin to the story, and which is expected to increase earnings and therefore justify the high valuations that we see today. And on top of that, you have Biden coming into the picture, and probably he will accelerate the fiscal stimulus even further. But from a GCC point of view, you can see that they will benefit from two points of view. One is that the non-oil sector GDP is likely to bounce on the back of the global rebound. And oil prices, the call has also been, we'll shortly see, has been reasonably stable. So, but on the flip side, as you can see here, the break-even oil price for GCC across the board, except Qatar, has been higher than the current oil price, which means that it is going to, result in a hole in their budget, which they need to fill either by drawing their reserves or by borrowing money from the markets, and they're doing both as we speak. So. Definitely, the bounce back in transportation and tourism is key for markets like Dubai, but I don't see that happening. Both the transportation as well as tourism would be under stress for 2021. Probably 2022 is going to be a bit better year for the GCC. Moving on, we can one thing that I would like to, of course, the speakers before me did caution, but there is this great grand disconnect between the Main Street and the Wall Street that Tarun alluded in the introduction. Here is a great article that appeared in FT by Muhammad Al and he probably, you know, makes us look at some cautions, which I think is very much required, especially when you see almost all investment banks being very positive on S&P 500. Now, where can the disruptions come from? The disruptions can come from a monetary policy reversal. Obviously, Jean explained that it is highly unlikely, and even the author of this article thinks that it is highly unlikely. So it can be a tail risk from a market point of view. Or you know that the low interest rates, not only during 2020, but even before that, for 10 years, the interest rates have kept low, and that has induced a risk taking that is disproportionate to what the investors' ability to bear losses when things reverse. So this is another problem area that we should look for. And but the most likely problem disruptor or area could be corporate bankruptcies. This is mainly on the back of heavy borrowings by almost everyone from investment grade to junk. And 2020 will go in the history as one of the years where the highest money has been raised on the bond markets. And you can already see the stress on the private debt market, which probably caters to those who cannot get access in the traditional markets. But bankruptcies would be a very, very big theme. But the one good savings grace is that it's going to play out over time. So it's not going to all fall on us in 2021. So yes, we are hoping for a vaccine-enabled economic recovery, and we are hoping that it will result in improving fundamentals that will justify asset prices, and there will be an orderly rebalancing in 2021. Moving on, that's a view that we should be aware of. But while everybody is bullish on US, people are also suggesting, Europe and emerging markets. Very, very simply, this is because of the structure of these markets. As you can see here, S&P 500 is very heavy on tech, and then financials. And Europe is very heavy on financials, but not on tech. And emerging market, it's a very careful balance between tech and financials. But the people are putting their bets on industrials, which are cyclical in nature, and materials. And these are the sectors that probably does well when economy emerges out of recession. And from a market structure point of view, Europe and emerging markets are better placed in terms of the sectoral share of these two critical sectors, which is the cyclical sectors of materials and industrials. And also emerging economies have very strong secular growth rates, and therefore they look relatively cheap. But US has become increasingly a concentrated bet on technology, as you can see from this chart, and therefore people are cautioning to look beyond US into Europe and emerging markets. Let's move to the next one. I will quickly talk about fixed income. I know the speakers before me spoke about it, but suffice it to say that, fixed income market is also experiencing as much a bull run as equity markets, if not more. The equity bull run is 10 years old post global financial crisis, but fixed income bull run is now entering its 35th year. And people have been calling a bear market for many number of years, and they've been continuously proven wrong. And you can see the performance of the various legs here for 2020, which with the tips being the best performer. If we can move on, I would like to focus more on the risks that are happening in fixed income market. This is a beautiful chart from Wall Street Journal that shows how money flows or liquidity flows into asset markets. And you can very clearly see that, there are certain, markets where the flows are disproportionately getting bigger and bigger, seeding, probably the roots for bigger crisis to come. Just look at this chart in terms of asset-backed or in 2008, how that sudden bulge in asset-backed securities resulted in the global financial crisis. Now you see a if similar, if not a bigger bubble in investment-grade corporate debt and government debt, and obviously it's not going to end well if the size of these rivers are going to be expanding like this. Obviously, it will result in a flood. So this is important to note in the fixed income market. Let's move on to the GCC markets. Again, in terms of bonds, it looks pretty attractive to me because they are experiencing excellent credit rating. And for a similar credit rating in Europe and other places, you actually have very low yields. So the yield differential between GCC and US Treasury is super attractive at this point in time. The GCC fixed income index in 2020 yielded about 8.6%, which is not a bad return at all. And the government papers are giving an yield in the range of about, as you can see here, between 2% to 4%, which is good from a risk point of view. If you just ignore Oman and Bahrain, but the other papers are really very attractive with the strong credit ratings. It's a stable and resilient market. And more importantly, this is a market that will be awash with the new issuance, both from corporates and governments, because governments are going to be in a debt mode, deficit mode for foreseeable future to come. And the corporates will also be actively tapping the debt market. So there's a lot of action on the debt side, and the recent inclusion of GCC countries in the JP Morgan Emerging Market Bond Index gives them a weight of about 18% collectively, and that's a good number to look at from a portfolio management point of view. Moving on, I will quickly also caution about what can go wrong in the debt market. I know Jean flagged that in her presentation, but it is very important to note two risks here. One is money raising by almost any company, even if it is a zombie. So raising money is not at all difficult. You just have to go to the market and people give you money. So that's the speed with which companies are raising money. Obviously, this will result in bankruptcies, and the huge growth of high yield debt market, which is now 4.5 times more debt than last 12 months earnings before taxes, and a ratio that exceeds the global financial crisis default cycle peak. So of course, we talked about inflation already in the earlier presentation, which can result in a taper trend in two scenario. But even glossing over that risk, this risk of defaults and bankruptcies is something that can easily go wrong for debt markets in 2021. So let's move further and talk about oil market, because we are based in the region, and I would like to give my 2 cents on this very quickly. Um, Oil obviously had a very rocky 2020. You can see that it had a huge fall and a relief rally, and now the call of oil price of 2021 across investment banks range from $50 to $65. So which probably is on the back of consumption falling terribly in 2020, and it averaged about 92 million barrels per day, which is a fall of 8.8 million barrels per day, which is unprecedented. Though we recovered 5.8 million barrels per day in 2021, it's still nowhere closer to the closing levels. Moving on, I think oil markets are in for a major disruption, as this is an excellent thing to look at in terms of renewable market caps and the traditional market caps. So here I'm flagging three companies: Nextra, Iberdrola, and Enel from US, Spain, and Italy. and look at the market cap of them in 2020 and how much they've grown in 2010 and how much they've grown in 2020 to be on par with the Chevrons and Shells and BPs of the world. So there is a huge shift that is happening under our feet in terms of oil markets, and this is something that the GCC policymakers should take a note and plan into their affairs. So I would probably jump here from oil to the, if you can move the slide, please. Yes. One parting shot on oil is that, yes, we have seen a 8.8 million drop, but what happened was BP suddenly called it as the peak oil, which we have already witnessed in 2009, whereas the earlier call was for the peak oil to hit in 2030. So that's a huge shift in terms of oil scare. So that probably confirms our view that things are changing very, very quickly. So with this, I will close my presentation. Of course, I have some thoughts on gold, Bitcoin, and of course, you must have heard those things from the speaker. So it's safe to gloss them over. So let me move to the last slide where the asset class views are given in terms of a summary. And as I said before, people are almost across the board bullish on equities and in parts on fixed income and to an extent on alternatives. So with this, I would like to close my talk, and I would be happy to take any questions that come later after the presentation. Thank you, Tarun. Thank you, CFA Emirates, for giving me this wonderful opportunity.
Great. Thank you so much, Raghu. And with that, we come to our last speaker of today before we head into the Q&A. That's Jim McDonald joining us from Chicago. Jim is the Executive Vice President and Chief Investment Strategist of Northern Trust, as well as the co-portfolio manager of the Northern Global Asset Allocation Fund. He chairs the Northern Trust Tactical Asset Allocation Committee, is a member of the Investment Policy Committee, and is a trustee of the 50 South Capital Alpha Strategies Hedge Fund. Prior to joining Northern Trust, Jim was a director of equity research at ABN AMRO. Jim holds a BBA from University of Michigan and an MBA from Babson College. He's a member of the CFA Society of Chicago and a registered CPA in the state of Michigan. Over to you, Jim.
Tarun, thank you. Can I confirm that you can hear me okay?
Yes, very well.
Excellent. Well, thank you so much to the CFA Society for inviting me to join today. I hope you've found the presentation so far useful and that I can wrap this up on a productive note. So our outlook for 2021 was entitled A V-Shaped Recovery, and that's a play both on the vaccine and on the shape of the economic recovery, which we are expecting to unfold and is currently unfolding. If I could have you switch to the first slide. We'll go to the next one. There we go. So just our goals today are first to talk about the 2021 outlook. Second, key areas that we want to focus on. And then what does this all mean for investors? How are we positioned in our tactical portfolios? And what do we think the risks are that we are facing? So I'm just seeing a quick chat that says, unfortunately, we cannot share the presentation, but it appears to be up. Tarun, is that right?
It is, yes. The presentation is up.
All right, very good. So let me just, a couple quick comments on 2020. Everyone knows the numbers, but just a couple of themes that I take out of this because they do set the stage for how we expect performance in 2021. And it starts with the big difference from a regional standpoint. And I would explain that predominantly by exposure to technology. So the technology companies obviously were a big beneficiary during 2020. You even saw with Microsoft's earnings overnight that 17% revenue growth for a company of that size is astonishing. We do expect some reversal of this in 2021, and it's not that we expect technology, and growth to struggle, but we expect the more cyclical parts of the economy and the markets to perform better. So you'll see later on that we've actually moved to an overweight on stocks outside of the US to partially reflect that view that the laggards that were behind the markets in 2020 will have some bounce back in 2021. The other significant message is what you see in real assets. So we own real assets for hedges against inflation and to add some diversified return into the portfolios. And whether it was natural resources, real estate, or listed infrastructure, they really struggled in 2020. We have taken some of this into account in our longer term outlook, in that the effect of the pandemic and the effect of technology are reducing the demand for some of these assets, and also the focus on ESG, we think, does present a hurdle to natural resources over the next 5 years. But I would say that was the other big message coming out of the returns in 2020, along with very positive returns in fixed income, which I know we've already talked about. So let's move to the next slide, which helps put into perspective, and I know we saw a little bit of this earlier, but I found this to be a very helpful framework in describing what transpired and how unusual it was, but not totally unusual, in how quick the downturn was and how quick the recovery was as a result. So the typical bear market has lasted about 2 years, peak to trough, and then it's taken about 50 months, so over 4 years, to get back to prior peaks. In the S&P 500, it was a 5-week drawdown, and it was about a 5-month recovery. So even if you go to the event-driven bear markets, which are the least severe of the three, structural being where you have impairment of the credit markets, cyclical being a typical inflation-led cycle where a central bank raises rates to kill the recovery, and then event-driven where it's an exogenous shock. What you see is, even relative to the exogenous shock bear markets, this one was extraordinarily short. And I think that's a reflection of how the markets have changed and how policymakers are responding. There is a greatly increased percentage of trading and investing done on computerized basis, which accelerates the ability of programs to be implemented. There's also much quicker dissemination of information. And then also central bankers and fiscal authorities are programmed to act much more quickly than they used to. All of that says to me that we are likely to continue to have shorter bear markets and quicker recoveries going forward. Let's go to the next slide. So the two biggest topics that really drove the markets in 2020 and are driving positioning in 2021 were the COVID spread and vaccines, and then secondly, the US election. So I'm going to spend a few minutes on both of these, hopefully not too repetitive, but I would say that clearly during the summertime, with the approach of a second wave, summertime in the Northern Hemisphere, and fear about a wave as we got towards the end of the year, at that point, without visibility on vaccines, there was increasing risk and concern in the markets. But as we got to the first couple of weeks of November, I would say we got to a best case scenario on vaccine development. And that is with the Pfizer and the Moderna vaccines both being at about 95% efficacy. I think that's a best case scenario for a couple of reasons. Number one, it is a higher likelihood someone will take a vaccine if it's 95% effective than if it's 60. Secondly, it avoids a very difficult ethical question and logistical question, which is, if one was 95% effective and one was 60, people are going to be hesitant to accept the 60% effective vaccine. So it increases supply by having two, reduces difficult choices. And then I'll remind you that we also are within likely a week of further information on the Johnson & Johnson vaccine, which is a one-shot vaccine that is easier to handle. And the early indications are constructive and positive that vaccine will be effective. Now we've got obviously distribution problems. Europe's struggling some now. The US is having some struggles, but we think the market will look through these struggles because of the high likelihood of increased vaccination and increased opening of the economies by the middle of the year. So let's go to the next slide, and I'll just spend a minute talking about the process that we undertook. And this is a bit of a complicated slide, but considering everybody on the phone is a CFA or CFA candidate, I'm confident you can all figure this out. But basically, it lays out the scenarios that we thought ahead of the US election, because it was a big deal for risk taking, depending on what the outcome was, because policy has been a big driver over the last 4 years. So across the top, you will see from left to right, the outcomes we thought were most likely to least likely. And then on the side, you'll see the key inputs we debate when we think about the outlook for markets and how we position portfolios. So is growth going to be a positive or a negative surprise? When will inflation crop up? What happens to monetary policy, political leadership, et cetera? The second scenario, which was Democratic president, Republican House, Democratic House, was the one that we thought was second most likely, would be the most positive for growth. So that's one of the reasons that we had a strong reaction in the markets in November, but also very much tied to the positive vaccine news. What we now have after the Georgia Senate election is the base case scenario. Small positive, small to medium positive for growth. And that is something that the market has been embracing, because we do think there is a lot of constraint on how far the Democrats will be able to go. The third scenario, blue sweep, which is a liberal outcome, really was rejected. And that had the most uncertain outlook for growth. And I think that's something that the market has taken constructively. So we think that the outcome in the US is probably positive from a spending standpoint, and any tax increases are likely secondary. So the market's going to focus on stimulus now with the potential of some tax increases later. The key will be how big corporate tax increases are, because the tax increases on consumers actually could be constructive for growth if it redistributes from high income, high savers to lower income, lower savers. So let's go to the next slide. Okay, so let me talk a little bit longer term, but then I'm going to get back into the tactical outlook. Some of you have seen this before. We're very focused on themes. And so we have 5-year themes out that really help us guide our views on the major drivers of the economy and the markets. And I really encourage you to consider a framework similar to this, whether it's these themes or others, but they help you stay in your seat when you get data that tends to be all over the map. It's easy to be whipsawed about the outlook for growth or inflation if you don't have a really solid long-term view. So the growth outlook, we think, will be hindered over the next 5 years as deglobalization continues. Massive monetary toolkit, a play on MMT, but it's basically a view that central banks will be creative and stay very easy over the next 5 years. The last one I'll highlight is stagflation tested. That is our view that stagflation, which has been a theme of ours for 4 years, and that is technology bringing all kinds of supply into industries at very low cost, has been a deflationary force. We think that remains in place, but will likely be tested over the next year because of the huge amount of fiscal and monetary stimulus. So those are some of the key themes that we're focused on. This is all in our capital market assumptions white paper, which you can find on www.capitalmarketassumptions.com if it's of interest. So let's go to the next slide and talk about our outlook specifically for 2021. So it is a more difficult return environment because of where we are from a yield standpoint, where we are from a valuation standpoint. And so what you'll see is we do have a much more modest 60-40 return forecast at about 3.9%. And that compares to a realized return of 6.2% over the last 5 years. And if you look at what we see from an equity standpoint, they're relatively modest returns, 4.7 up to 5.4%, because of, after this big bounce, relatively slower growth and somewhat elevated valuations. And where that leads us is the highest returning asset class, where we absolutely see continued strong interest amongst our clients, whether it's wealth management clients, endowments, or sovereign wealth funds, is in private equity, where we expect a 300 basis point premium to be realized over the developed markets globally. 300 sounds maybe a little bit ambitious. It's been 500 basis points over the last 5 years. So we've actually haircut it because of some concern about the amount of money that's chasing private equity deals. But where we feel best from an implementation standpoint is on the small and mid-sized private equity firms, where we think they've got the best opportunity to find deals at a reasonable size and a reasonable valuation. So let's go to the next slide and talk about the interest rate picture. So what I've laid out here is where the 1 year forward markets are and where our forecast is. And you'll see across the board, we have below market forecasts for interest rates. And that is because we think that the technical pressures on the market from central bank buying, from pension plan buying, will remain very strong to hold rates from any material increase over the next 12 months. And that is also supported and, importantly, very dependent on our view that inflation is going to stay low. The impact of stuckflation will be robust. So we'll be paying a lot of attention to what happens with wages. Once wages get above, in the US and other developed markets, a 3 to 4% rate, that's when you need to start worrying about inflation becoming a bigger problem. If we go to the next slide, we remain favorable towards high yield. Of course, there are concerns if the economy rolls over, high yield will have problems. We completely agree with that. High yield actually did not even meet the investment grade return in 2020 because of the significant price return through the drop in interest rates. But we see that flipping in 2021, where basically the current yield will be driving the return that we expect. When people worry about defaults in high yield, which of course we pay a lot of attention to and are concerned about, the single best forecaster of future defaults is the level of current distressed bonds. So those trading at $70 or less. That level has come way down over the last 6 months. And we think that's tied not only to policy, but it's also tied to the fact that investors are expecting a robust economic recovery. So you'll see later on, high yield remains a favorite asset class for us. Let's flip to the next slide where we'll talk about what's going on in the equity markets. So what we always do is to do a bottoms up build up and also a backward looking decomposition of where returns came from. And so what you'll see is the things that were negative in 2020, which is big drawdown in earnings. So EM was the most stable, US was next, Europe was second, third worst, and Japan was the worst. We expect those earnings to bounce robustly in 2021. So of course, the markets anticipate that. You got a big PE expansion in 2020, which is how you got the positive returns. I am not generally dissuaded when people bring out a bear case that all the market returns in 2020 were driven by PE expansion. That always happens. Anytime you have a big cyclical downturn and earnings collapse, investors start to look through it. So what does that mean though for 2021? If you look at the chart, it really highlights the reliance on earnings growth. But it also shows that we do have built in some significant valuation compression as stocks grow in to those earnings numbers. So we think we'll get the best results out of emerging. We think US is probably got the least rebound potential, And you'll see that we've reflected that in our tactical asset allocation. So we'll go to the next slide. And talking about what we're seeing in the real assets category. So as I mentioned earlier, real assets struggled in 2020. We think some of that struggle will persist over the next 5 years, but some of it, like global listed infrastructure, will actually look pretty good. So from a natural resources standpoint, we do expect some cyclical rebound, which we're clearly seeing some benefit of early in 2021. But we do expect pressure over the long term from decarbonization to reduce the demand for natural resources and natural resource equities. Global real estate, we expect some bounce back, but we've also haircut our expectations over the next 5 years, tied to a view that there will be less demand for office space. Companies will use the pandemic as an excuse to cut costs. And we also think that the retail space will continue to be pressured by the move to online retail. But of course, there are positive segments, and primarily the logistics area has been a great one. And then global listed infrastructure, we expect to see some bounce back in 2021, as that was an area that was really hurt by reduced demand for transportation and travel. And we expect bounce back of demand. So that is also a favorite asset class for us over the next 5 years. So let's go to the next slide, and I'm getting towards the end of my prepared comments. So what does this mean for investors? We'll flip to the next slide. So 2 quick comments. We underpin everything we do with a 5-year outlook. And then our tactical outlook, so hit the next slide button. The tactical outlook is something that we meet on a weekly basis to talk about interest rates and credit. We meet on a monthly basis to talk about the overall risk positioning, and then recommend tactical shifts based on where we see a 12-month opportunity different than our strategic outlook. And this is something we publish on a monthly basis. I've chaired our tactical committee now for 14 years, so we've got a good process in place with consistent results. So where are we positioned today, and then what are the risks against that? So the next slide will show you our tactical positioning. So the way to read this is the strategic column is if everything was in balance, we would have no tactical bets. That would be the weighting. And then on the right-hand side, how are we positioned today? And I've laid out the thesis for most of these during the discussion. Tactically overweight non-US equities with a view that the laggards, which is primarily developed X, is going to bounce back with a cyclical recovery. And so we want to be overweight that, overweight the bounce back in listed infrastructure. We still like high yield as a very good risk-adjusted return asset, gets a significant amount of the upside in the equity markets with only about 50% of the downside. And you have to fund that from somewhere, and we're funding it from risk control assets. We don't think you're going to get paid in inflation-linked bonds over the next 12 months. We're also underweight cash and a slight underweight to US investment grade. So this puts us moderately overweight risk relative to our total risk positioning. Finally, what could go wrong? I'd say there are really 3 things on the next slide that we're focused on. The first is, this is an interesting one, we don't have enough risk in the portfolios, and that risk assets continue to run up. They could run up just from investor enthusiasm and flows, or they could run up because earnings are much better than we're expecting. So that's something we're paying attention to. I think more impactfully is the issue of stagflation being tested and failing the test. Do we actually finally get inflationary pressures that aren't just cyclical, but are secular? That would pressure interest rates, and that would be a problem for risk taking. The final risk I would mention, of course, is kind of an obvious one, that something really goes wrong with the vaccines and the current virus, that we have a mutation that really presents a problem. The history of virus mutations is they tend to mutate and become more contagious, but less severe. And that has been the case so far, but we'll be paying a lot of attention to that. So that's how we're feeling about the world, and I'm happy to get into our Q&A session.
Great. Thank you so much, Jim. And I'd request all the attendees to use the chat function for any questions you may have for our speakers today. And if you can kind of mention which speaker you would specifically want to answer that question. So I'll start off with some questions as our participants warm up to the chat function, and uh, I want to start with Jean. Jean, if you can, what are your thoughts with the new president in the U.S.? You covered it briefly with the new Biden presidency on the U.S.-China relationship, and how do you think that's going to impact investors holding Chinese assets?
So Taryn, this is coming to me, Jim.
Jean.
Jean, that's what I was concerned. Okay,
Singapore.
thank you. Go ahead, Jean.
Jim will talk about US and I'll talk about China, maybe.
Okay, yeah, happy to do it, Gene. So I'll just offer a couple quick comments, and I'm very interested in your comments on China. So I think that the strategy will not change dramatically, but the tactics will. So I think that it is very clear that there is a change between the West, not just the US, the West and China. And so we don't expect there's going to be a rollback of the tariffs. We don't expect there's going to be a rollback on pressure. There's going to be issues with Taiwan, freedom in Hong Kong, et cetera. The Biden administration, I think, will put some more pressure, but it won't be as erratic as happened under the Trump administration. The final point I would offer is there is concern amongst global investors and certainly in the States about China's involvement in private companies and what's happened with Jack Ma, what's happened with Alibaba. So there is some concern, and I think there will be some discount that continues on Chinese companies because of the potential of the state getting involved in those public companies. But the overall growth outlook still looks really good, and so I think that will help offset some of those negatives.
Yeah, thanks, Jim. So I don't believe that this will go away, the US-China tensions across the board, right? I think the US-China rhetoric is popular and bipartisan. It is not a Republican agenda per se, but really, I think, as Jim did point out, it's across the board, whether it's in intellectual property, and potentially even in the climate area, that this will continue. The last couple of weeks have been particularly concerning, I guess, and volatile, in that the list of companies on the CCMC kept growing, and the implementation was erratic and unpredictable. I think that actually caused a lot of disruption to the proper functioning of the capital markets. Not something that we were used to in the public markets, frankly, that companies could be removed from listings or indices in a moment's notice. I think that kind of behavior or that kind of phenomenon hopefully is a thing of the past. And even if a list of companies were on the watch list or sanctions list, we would hope as a proper functioning of the capital markets that this happens less. I think we will have to still live with the event risk on that front, whether it's geopolitical and it will flare up at any point in time. But what we hope to expect is perhaps a more rational discussion and negotiation of two superpowers, right? And hopefully a return to slightly more predictable manners of negotiation and multilateralism. I think what has characterized the Trump administration is a general lack of willingness to exercise the norms that the developed world, if you like, has been used to, which is the ability to come together and discuss something at the table and know that it's a question of not just binary decisions of winners and losers, but really to find a balance of interests and also balance those risks. So that I think will characterize hopefully in the nature of the discussion in the next couple of years.
Thank you, Gene. Yeah, I guess most people seem to share your views and those of Jim as well. Raghu, if I may ask you, I think thank you so much for covering GCC economies in a little bit of detail. Uh, but this COVID pandemic, we've seen fiscal stimulus all over the world, but we haven't seen much of fiscal stimulus in the GCC economies, even though they're quite cash rich. So, do you think you could speak on that a bit?
Yeah, sure. It surprised me as well. But because the GCC economies are quite rich in terms of they have the money to throw at the problem, but they choose not to. Uh, the reason could be that the size of the private sector, which requires help in the pandemic. So if you look at markets like India or US, they have a huge private sector, especially the MSMEs, the medium and small enterprises. In GCC, I think it is way down by oil and the government. So the government then chose not to help themselves. So it's as simple as that,
Right.
because if if they had pressed the fiscal stimulus button, it would have meant a huge slosh of liquidity chasing private actors, and they are not too big anyway in many of the economies. So, but I also noticed that back in 2008 and 9, when global financial crisis happened, I think there was a reluctance to throw money at the problem, and that meant that the time taken to recover was really very huge. And they have the same problem now. So probably the non-oil GDP recovery is going to be taking more time than anticipated because of that. So that's the call that one should make as to the speed with which you want the recovery to come back. And if they had pressed the fiscal stimulus button, probably the recovery can be swift and strong. But I expect both not to be happening because of the very tepid fiscal stimulus by GCC countries in general.
Right. Right. Thank you. Laura, coming to a little bit of on the European side, a few years back, we would have all these existential questions on the survival of euro with the southern European countries and Germany having such divergent interests. And somehow now those kind of questions have really gone away from the public debate. I think there's been a lot of structural changes in a lot of European economies. Uh, could you give us your thoughts on that?
Um, I think this is a matter of fact, all right. And I think Mr. Draghi, the former president of the ECB, has done a lot, let's say, to prevent any collapse from the eurozone. And let's say, and this is what I said also, fighting against the fragmentation of credit and fighting against what could have created such a distortion between the economies, all right, then it would have exploded. Right now, the monetary policy, and I would say the fiscal stimulus are going in the same way. More cohesion, more coherence, and some willingness from the different countries. And yes, you can say Hungary, or there can be some small countries that are a bit different. But let's say the leaders of Europe are moving toward getting this cohesion to, let's say, build a stronger Europe. And they have no choice. They have no choice because Europe has been attacked on the trade war has been attacked on the technological sector. So now there is some kind of consciousness about the fact that this is time to react. And the only way to do it is not to do it separately, but to do it together. And as far as France and let's say Germany, the main leaders of Europe, are moving in that direction, which is the case. And there is an event that we haven't spoken about, is the fact that Mrs. Merkel is going to leave the scene. And she normally should be replaced by Armin Laschet, which is really a close friend to Mr. Macron. And this is also key in understanding the fact that this coalition is not going to fade with Mrs. Merkel dismissal, and the heritage that she wanted to bring is really moving into this ratification of the plan that is also linked to the fact that for the first time, the Europe has decided to issue together. And the fact that you issue Eurobonds gives you some credibility about the fact that the euro is not going to blow down and the Eurozone has some future.
Thank you. Jean, one always feels that some of the data coming from China is always a little less reliable, and one hears a lot of speculation about the levels of debt that may be on or off the balance sheets of Chinese banks. How do you see this playing out in China with US now announcing such a large stimulus? Do you see some currency changes in the yuan, or are you going to see that with the dollar depreciating, is that going to be an issue for China?
Yeah, thanks for the question. So I think one also has to always treat data with a healthy skepticism, regardless of where they come from. But I think we're also in a world where it's not difficult. I think Laurent pointed to the term, to the practice of using AI and big data as corroborative evidence. And the truth is, we're no longer in the era where we only read the People's Daily for news, and it is an open environment, and increasingly so. And China does want to build its credibility to the in terms of international investors, whether it's opening itself up in terms of to the ratings agencies or towards institutional investors who are now going onshore. You have the likes of the big boys from the US and like BlackRock, etc., setting up shop there. So gone are the days in terms of that aspect of ability to control information to the extent that it was possible in the past. So I think there is sufficient checks and balances from an investor or institutional investor governance point of view. Having said that, it is not something that it still remains a risk, right? In terms of excessive debt, we have seen that many times in the past in China, where then there were excesses, whether it's in the retail market, bubbly sort of phenomenon in the small cap space, etc. But you've seen also China increasingly very taking a lot of steps to guard against that, such as in just the MSCI China Asia inclusion into the MSCI EM indices, the conditions and the criteria are actually very stringent in terms of the corporate governance and the ability for companies to do that. And I think the move towards ESG investing, sustainable investing, and rating of companies in terms of sustainability goals as well as governance metrics will help the general environment there. In terms of from the macro environment, macro front, as you point out, I think the PBOC governor Yi Gang was also quoted in the World Economic Forum, which is happening in the last few days, as saying that China is also in this, while China is the first perhaps to emerge from the recessionary environment into a very strong growth, it is not also in a hurry to pare down in terms of the support on the fiscal and monetary front. I think we can draw comfort for that. At the same time, we all know that the currency is very much managed, I would say, and therefore I think while China will allow the currency to appreciate, there's probably in terms of the macro environment, it's still very much managed. So I don't think it's a question of them sort of pulling back on the stimulus at this point in time, because I think there are still quite a lot of fractures within the economy that will take time to truly get on the path of recovery.
Thank you, Jim. Jim, if I may just turn to you. We had 2020 had this the coinage of Robinhood traders, and in the US, I think one saw a great amount of participation by retail investors in in risk assets, whether be they equities, be they bitcoins. Uh, you mentioned that there is every bull run has multiple expansions, but do you think this is something that is going to be worrying going forward? The easy money, the amount of money that is sloshing around.
Yeah, so the impact of the retail investor really became very apparent in the middle part of 2020 in US trading, in that you started to see tremendous speculation in bankrupt companies, which made no fundamental sense at all. And now you have seen it in recent days in the US with companies being targeted that have very high short ratios. And so the traders are going after and basically creating short squeezes. I don't believe this is going to create a macro problem for the overall market. I do believe it is creating problems in individual stocks and maybe individual sectors, whether it's what's happening with the SPAC issuance, what's happening with cryptocurrencies, or individual stocks that have inexplicable rises in their valuations. So I think it's more of a narrow problem than it is going to be a macro problem for market valuations.
Okay. So Raghu, there's a question for you, more so in terms of what you talked a little bit about real estate, and the question is that do you see this oversupply in UAE real estate putting a lot of pressure in the economy? And how do you see that playing out in UAE or GCC real estate equity performances?
Um, yeah,
And
I
if I
think,
may, Raghu, if I may just add on quickly
mhm.
to that question, we also felt that GCC has probably from 2010 to 2020 experienced like a lost decade syndrome. What would be your thesis going forward on GCC, and specifically also covering real estate?
Sure. There are two parts to this question. First, on the real estate, obviously, again, it differs from market to market, but specifically focusing on Dubai and UAE, until and unless the economy comes back in terms of tourism and transportation, I think the oversupply factor will play out in big measure for Dubai, which will obviously result in the listed real estate stocks underperformance. But I must say that the distressed real estate market provides a fantastic opportunity, and that can play out more on the private equity side. But I see a huge potential developing on the distressed real estate market for UAE. This is on the real estate, and in terms of the last decade, of course, glorious historical performance means terrible prospective performance, and vice versa. So GCC markets have had a very you know, flat decade. And in terms of stock markets, even though they have some of the finest companies listed on the stock market, and some of them are, many of them are very investor friendly in terms of dividends and shareholder friendliness and the business models. So it's very unlike the GDP structure of the region, where very few oil companies being represented on the stock market. It's mostly banks, financial services, real estate, insurance, and retail companies. So going forward, I believe that a terrible past performance might lead to fantastic future performance, provided there is active management at play. Hugging the index is a bad idea, and doing research in GCC is extremely difficult because of lack of information, and that's where research can pay off big time if somebody is very actively focused on managing and finding solid companies to invest. So the next 5 years is going to be good on the back of the demographic, infrastructure, and investment landscape of GCC, not so much on the oil play.
Cool. I think a lot of people here listening on to you uh, would be hoping that what you say comes true, given that the domestic tilt that most investors have over here. Laura, coming, I know that Odo had launched an AI fund almost 3 years back, and you've also talked about, the ESG element in your portfolio. Could you give us something more specific in terms of, you talked about, I think, speech analytics in AI. Uh, any specific, more specific companies that you can talk about in terms of actual implementation, or things that comprise in your portfolio, both from an AI as well as ESG perspective?
Unfortunately, as a CIO, I'm not authorized to speak about any companies. All right. So, but nevertheless, I can speak about the way we apprehend it, and maybe if you allow me, I would come back to the question raised before entering, and I would do it very quickly, to the retail investors. You know what just occurred with GameStop, or this company that's come from 30 to 300. All right, so it was the most shorted stock, and Jim has spoken about it. But the issue, all right, is not, and I fully agree with you, Jim, it's a micro economic issue, not macro one. But nevertheless, it's very important for investors. Why? Because for Tesla, for example, Tesla is now part of the indexes, meaning that for institutional clients, they need to take it into account, all right? They need to apprehend, all right, that kind of stocks, that kind of moves, the moves from retail investors, that can drive some performance, and then that can bring some kind of risk. You need to monitor the risk that is embedded by the momentum from these retail investors, this kind of community trading that is taking place, that can distort performance if ever you don't take them into account. And how can you do that? And I still believe that artificial intelligence, checking big data, those blogs, all right, those Robinhood platforms, they provide blogs, or you can have a look at Twitters, and let's say, and you need, of course, to monitor the data and to be sure that this is not garbage in, garbage out. This is very important. But nevertheless, once you define themes, once you define topics, all right, and you can define the sensitivity to one to one theme of your portfolio, and then monitor better the risk. The way you do that is to use algorithm of big data to define a theme, and then select the stocks that are related to it. Then this is what we are doing, and it's done through NLP, natural language processing, and again, a part of artificial intelligence. Is it the only one? No, machine learning, but be very cautious about machine learning I think it's really more about data analysis than trying to learn something, all right, for the time being. But let's say, again, I repeat myself, 80% of the data now are unstructured. You need to take them into account to let's say, monitor the environment and to make performance, as simple as that.
Thank you. Jim, if I may, just staying on that same question in terms of, the market valuations and so on. The joke that went around was that, a trader got fired on the floor for using the F word, and the F word was fundamentals. Uh, and now we don't have any trading floors, but nonetheless, I think the sentiment is quite something that one can relate to. Uh, now, you've very kind of elegantly talked about that stagflation and the deflationary effect of technology on the economy. Do you see certain industrials and old economy value stocks coming back in the next 5 years?
So, Taryn, we do think that we are going to get a rebound of what we're calling the laggards. And so that's one of the reasons that we went overweight, developed ex-US, which has got a much lower weighting in technology than the US or emerging markets do. So we do expect some significant improvement in relative performance. We get asked all the time, are you making a value call that value is now going to start to outperform growth? We don't feel that strongly that it's going to, because again, you look at Microsoft reporting 17% revenue growth. For a company of their size, that is just astonishing. And it's a great summary of how important technology demand is today. But we do feel that there's going to be a much smaller difference in performance between growth and value over the next 12 months. So there was some discussion if we should go underweight the US, if we really want to make a call that we're going to focus on the laggards. And we decided that was too risky because of the strength of the technology wave.
Cool. Thank you. Raghu, I must say that no talk or conference in in the Middle East can be complete without having a little bit of a question on oil. And you touched upon the oil price and the break-even oil price. Uh, could you just elaborate that, unpackage that for audience here?
Sure, Tarun, that's an interesting question, because for an analyst, what matters is the break-even oil price. It's the oil price that enables the state budget to balance. So you can see that in my chart, it's hovering around 80 to 100 for most of the GCC economies except Qatar. So you can understand break-even oil price as something that you need to really balance your budget. So the required oil price at 80 or 100 is far higher than the current oil price. So the problem is the break-even oil price is a function of your expenditure, and the expenditure structure of GCC is more in favor of what they call as current expenditure, mostly comprising salaries, wages, and subsidies. And it has to keep increasing because the bulk of the local population is employed with the government. And there is a social contract between citizens and the government, and there is little flexibility on the part of the government to really play around and reduce this expenditure profile. And also the GCC governments are in need of huge infrastructure spend, the second wave of infrastructure spend, what I call, right from Saudi Arabia to Kuwait to all the economies. So which is the capital expenditure basically. So you have a very inflexible current expenditure and you have a huge requirement for capital expenditure. So put together, these two things will make sure that the break-even oil price or the required oil price will keep moving up, not down. So when the required oil price moves up and the current oil price stays low, you are in for a increasing deficit, which has to be financed by a drawdown from reserves or by issuance of bonds in the global markets. So that is the implication that we have to understand. It's a structural implication. It's a long term, so expect more of bond issuances, a lot of happenings in the bond market, and probably this wide consistent deficit year after year might have an implication on the credit rating as well.
Thank you, Raghu. As we come to almost closing time, maybe I can pose a question to all the speakers, which is basically if we were to do a pair trade, that you had to go short on something and long on something, one within your domestic or within your specific region, and the other, across the globe. Uh, I think if you can kind of elaborate what that could be. Jean, shall we start with you?
Okay, thank you. Um, in terms of what I would long and short, I think I would long China from a long-term structural perspective.
China is in
both-
Chinese equities, I mean.
Yes, Chinese equities. And I think, Tarun, you mentioned that many investors in the region, in the GCC region, are very domestically oriented. I think it'll be important to diversify that clearly from a global perspective, perhaps including from developed markets into Asia, especially China. I think this is a structural change in China and Asia in terms of the trajectory that you're about to witness in the next decade. Some of the questions on the chat, me, is with regards to this rather sensitive topic of dependencies between US and China, and whether there will be more of these. I think I'll just quickly summarize because this is important also to my long view. If you look at the animal kingdom, the countries, the animals that survive the test of extinction are not the brainiest or the fastest, but the most adaptable. I mean, that's a fact of evolution. But here, I think it applies for countries and companies and economies as well. So the adaptability of China is phenomenal. They have the advantage of scale clearly in terms of the population, etc. So what China recognized in the last 4 years is that an export-oriented economy where you are the factory of the world makes you vulnerable to a few things: trade protectionism and recession, a global recession, even if your domestic economy was doing well. So the dual circulation policy is quite key. That means building your own capabilities, especially in technology. So whether in tech innovation, EVs, you'll expect to see more and more space tech, etc., from China. So you have to at least position yourselves from an investor's point of view to gain exposure to this. The US is not going to be a sitting duck in this area as well. So dual circulation also means an internal economy, but also an external environment. How you do bilateral agreements, as China did with the RCEP, economic cooperation, and also treaties with even the UK, Japan, etc. So US is going to do a similar thing, which is its version of dual circulation. I'm sure they won't use the same name, which is to build the domestic resilience in technology and certain areas of strategic importance, but at the same time build multilateral links to the world, whether it's with Europe or the Middle East or the rest of the world, to also buffer the power balance between the two. So I think China is an important market. Now, what would I short? I think oil economy, energy. We all would like to argue that, we all need oil for many years to come. And given that this GCC, I won't presume to be the expert at all, and Raghu has also point out a lot of both the opportunities and risks as far as the oil price goes. But from a long run perspective, I think the climate change agenda and goals are very significant ones. And they will be very dramatic in terms of the incentive structure, for better or for worse, for companies. So I think energy companies that are clearly evolving and improving their operations and reducing their carbon footprint or even their business models, those are still fine, but there will be some that will go extinct.
Okay, so long China, short oil.
Not all
Raghu?
oil, all economy energy companies to be specific.
Okay. Raghu, if I may come to you.
Yeah, sure. I'll be quick. I'll be long on GCC bonds, government bonds especially. As I explained, the yield differential is quite a no-brainer to tap into. And I'll be short on MSCI emerging markets because it's a very heterogeneous group, and with so much uh, differing factors coming and coalescing together. And they really have a huge inflation threat thanks to the fiscal stimulus to manage the COVID. So, if there is going to be a stress on the global markets, it will show up much more in emerging markets than global markets. So, I would be short on MSA Emerging Market Index, and I'd be long on GCC government bonds.
Very good. Laura?
I would have some kind of humility about our macroeconomic perspectives and let's say the way we can apprehend, our asset allocation in such an environment that we haven't seen. All right, this is unprecedented. In that sense, I would favor flows, meaning that this is certainly what should drive. Because asset allocation, it's about the macro, it's about the valuation analysis, but also flows analysis. And in fact, I think the ecological transition, and we've spoken a lot about it, but the flows and the money that is going to be directed to this theme is so huge, all right? And I repeat the numbers I've been saying, 1.5 trillion to 2 trillion per year of investment globally means that there would be tremendous opportunities of investment that would be driven also by those flows, all right? So I would favor, let's say, green type of, or let's say climate change indexes. And then I would short the US dollar. Why? Because I think the twin deficits are about to increase significantly. And I think it's about the rotation in terms of growth that is at stake, maybe favoring Europe on that sense. And I do believe that the fact that Joe Biden has won the two chambers is a key event. And yes, he won't implement his full package, but nevertheless, 2 trillion package is going to impact significantly, all right, those deficits, meaning that the dollar, which is overvalued by around 20%, has room, all right, to move down. And I really believe that it is not going to be seen in the coming future as the safe haven that that was the case before.
So in terms of implementation, if I summarize, you're long clean tech and short dollar.
Yes.
Jim?
So I'll throw two out. One is based on our current positioning, which would be to be long Europe and short tips. And the thesis is that we're going to have a strong recovery without inflationary trends. And then the second is more of a hedge. And this would be to be long natural resources and short global sovereign bonds, with a theory that if we're wrong on the inflation front, that sovereign bonds could be clobbered, but natural resources will give you a nice return in that environment.
Excellent. Well, I guess it's, I think, close to time when we have to call this conference to a close. So I must thank all the speakers, Jean, who's been up till almost like, I guess, 11:30 in Singapore, and Jim, who got up, probably joined us at 6:30 a.m. Chicago time. So Raghu, Laurent, thanks so much for sharing your time with us. None of this could have been possible without also, the support staff that we have at the CFS Society Emirates. So I'd like to thank Evie and her team, Blessy and Sivan. Thank you so much for helping put together all this. And I'd like to thank all the participants who were able to join us today. We at the society want to do these events for you. So if you find value, please do take part in the polls so that we can continue to bring presentations and speakers to you which add value to you. Thank you so much, everyone, and have a great rest of your day.
Thank you.
Thank you all. Thank you, Tarun.
Thank you.
Thank you, Tarun.
Thanks, Tarun.